Federal Reserve is stuck. There are no signs that inflation is slowing down.
What are you waiting for?
So, believe it or not, this press conference is not all I've done today.
Now, between all this, reporters and investors are trying to figure out how they can understand what the Federal Reserve's next move is going to be. Now, before we get into it, go ahead and like and subscribe if you're looking to make money in any market and if you're looking to find the next biggest stock. Now, surprisingly, the Fed was actually split on what they wanted to do this meeting.
We have spent an inordinate amount of time in the last 2 days, 2 weeks, looking at our monetary policy strategy, thinking hard about the sources of data that we have at our disposal and we wish we had. 3
Fed officials voted for a rate hike while 9 voted to keep them steady. And that's what the Fed did. Rates were kept the same. So why do interest rates actually matter so much? Interest rates stimulate the economy. In Keynesian economics, raising interest rates contracts a market. Why? Because when money becomes more expensive to borrow, less and less companies are going to borrow money. A simple way to think about it, higher interest rates means not as many new jobs and not as much opportunity for businesses to expand. Now, when interest rates are low, it's the exact opposite. You can take out more money, stimulating the economy. Businesses can hire more people. They can expand. Lowest interest rates undoubtedly expands an economy, but you have to be careful because if interest rates are too low for too long, inflation can run rampant. So now that you understand why interest rates are actually important, how can you actually protect yourself? The number one thing, buy assets. People who own assets or businesses don't necessarily care so much if inflation is running rampant. Why? Because the prices of their homes go up, the prices of their investments go up. But they do care if inflation gets out of control because now it's just everything's going up on paper. And look at the stock market. It's up year to date, but it doesn't feel that way, especially in the last month when the S&P 500 is down over 4%. However, you're still up year to date. The S&P is up around 6.5%, while the NASDAQ is up over 9% still. I see a lot of people online saying, oh, here's the next crash coming. It's going to be really hard for the next crash to come when inflation continues to run rampant. Now, what do I mean by that? Well, if you have a stock priced at $100, but inflation continues to go up, you basically have a free weapon fighting the price from going down. Well, because while the true value might be going down in the company, its on paper value is maintaining or not going down as much, or even better for investors, going up still. And unless inflation is double digits, you're not going to feel the pain. Some people are saying that the market has already priced into additional hikes. I'm not convinced of that. However, if it does happen, that'll mean that inflation is continuing to run. So what's one of the biggest drivers of this right now? It's the war with the US and Iran.
New government data shows inflation soaring at the fastest pace in 3 years, and the skyrocketing cost of gas is to blame. Inflation was higher than expected in April, prices surging 3.8%. Gasoline is up 5.4%, and AAA says gas is averaging $4.50 a gallon, 44% higher than it was a year ago. For the first time in 3 years, inflation is outpacing wage growth.
The obvious factor of this is that it's driving oil prices up. So what's the not so obvious way that this war is affecting interest rates? It's the 30-year Treasury. And the 30-year Treasury just jumped to 5.21%. That is the highest that it has been since 2007. Now let me translate that because it sounds like a Wall Street number, but it's not. That is the amount that the US government pays to borrow money. The higher that rate is, it will directly affect inflation. Now, why does this also matter? Because we're in the middle of a war and the US government is needing more money to fund this war. It means that the world is repricing the risk to hold American debt. And the bill for that does not land on the Federal Reserve. It lands on anybody in the United States who's looking to borrow money. So what do you do with all this? Number one, you do not panic sell. Wars are the single most reliable historical indicators of inflation. Inflation is going to be present and it's going to continue to happen unless this war gets resolved tomorrow, which it doesn't look like it's happening anytime soon. Number two, for your investment portfolio, you need to start looking at which companies are profitable. We're not in a growth at all costs segment anymore. This is a which companies are actually increasing their revenue and which ones are at least maintaining their gross profit levels with it. Thanks so much for watching, guys. Go ahead and like and subscribe if you're looking to make money in any market and if you're trying to find that next biggest stock.